There we go.
Got it.
It's going. Hey, you guys, thank you guys for being patient. For those of you jumping in, one of those things is, gotta love how COVID is introducing us to technology. So, Ms. Jan, if you don't mind just keeping an eye out on the, down there at the bottom for the participants. I know that might be a little bit of a distraction, but what we'll do is, if there's some people in the waiting room down there, I'm gonna real quick, thank you guys for waiting. I'm gonna real quick go through some, just some announcements, okay? All right, well, good stuff. Look, for those of you who don't know who I am, my name is Courtney Fricky. You'll see me if you go to, the show The Grid, if you go to where you can see all the participants. So my name is Courtney Fricky. I run Northshore REIA, which is a local way to learn about real estate investing. It's great for education, but it's also great for networking. Thanks to COVID, we've kind of been thrown a little bit of a loop and a wrench in the plan. So since March, we've gone mostly, actually all webinar. We've done anywhere from 1 to 3, even sometimes 4 webinars a month. But starting, and I'll tell more about this in a few, but starting in July, we're gonna start weaning our way back into in-person meetings. So I wanna give you guys a few tips and resources up front. So Northshore REIA, it's free, it's open to the public. Normally we have 1 to 3 meetings. So one of the things is they're free. Thanks to some local sponsors we have, which that came around for people who are asking questions on, hey, who do you recommend for this? Who do you recommend for that? So I'm gonna put in the chat section the link to where if you'd like to see some information, maybe you're looking for a real estate specific CPA, maybe you're looking for a title company that works well with investors. That is where you can find it. And so if you wanna pay attention down there, we have a few upcoming events. So first of all, the next event is going to be July 2nd, which that is going to be what every real estate investor needs to know about house hacking. So if you're living in a house right now, maybe you're wondering, hey, how can I include my investing goals with where I live? Maybe you've heard of things of house hacking, like where you live in one side of a duplex and you rent out the other. Maybe there's things like the idea of living in a house, fixing it up, and then reselling it on the back end. So we're gonna deep dive that. Bob Norton and myself are gonna deep dive that on July 2nd. On July 7th, I've invited a friend who is, she is a high producing real estate investor out of Texas. That's been the beauty of these webinars, is I've been able to bring some of my friends from masterminds as well as other places into speaking into you guys' life and giving you guys some value. So on July 7th, I've asked my friend Mitzi Diane, she's a Mitzi Childress out of Texas. She's a single mom. She owns apartment complexes and she has a real estate company. For some of you guys know things about like wholesaling. She's done a $400,000 wholesale assignment fee. She does high level as far as development, apartments, even down to small $10,000 houses. So she's going to talk about mindset, and she's going to talk about finding your flow, because that is one thing I have found. Every mastermind I've been in with people who are producing at a high level, they talk about the mindset you need to get there. So that's going to be huge. I know I'm looking to tune into that. And then lastly, we have July 14th. That is going to be our first in-person meeting. That is going to be in Covington at the We Stay Suites. And so keep an eye out for that. We're actually, if you guys recall, March, when everything kind of hit the fan, we immediately gathered a panel of people from all across the real estate community and the real estate industry. And we said, hey, how is COVID affecting your business? And what are you doing to adjust? We had lenders, title company, realtors, property managers, flippers, you name it. We had a CPA, we had the retirement community as far as like self-directed IRAs and stuff. They spoke into it. I've invited a lot of that same group back, and they're going to do it. Either they're going to send in some response or they're going to be there in person sharing. I know you guys gave great feedback to that when we did it back in March. And we look forward to doing it because, look, the world is changing before our eyes. It's almost, Paul, my business partner, and I, we joke about it's like post-Katrina times. The world's changing every few days. So that's going to be on July 14th, and it's going to be in Covington from 6:30 to 8:30. It's free, open to the public. We're going to be COVID conscious, so there will be like a sanitation area. You're welcome to attend if you feel comfortable. You're welcome to wear a mask if that's what you prefer. We are going to be paying attention to local regulation and what is required and what is recommended. The other thing is, guys, it's going to be recorded. So if you don't feel safe, but you still want to pay attention, that is going to be there. A few more announcements before I pass everything along here. We're going to get talking about 1031 exchanges. Many of you guys know that I have the privilege of being on WWL every Saturday from 11 a.m. to 1 p.m. If you're not aware of this, from 11 a.m. to 1 p.m., I join one of my partners, my partner, Paul LaGrange, on the Home Improvement Show. And for those of you who know WWL, that's 8:70 a.m. If you're local, that's 105.3 FM. And it's a call-in show. So Paul, who uses his decades of experience, talks about home improvement side. It's a call-in show to the degree, guys. If you have rentals, if you have problems in your own house, problems with the flip, call in and you get free advice from someone with decades and decades of experience, who's also a consultant now, who has a wide breadth of experience to tap into. You can call, you can text, and I share on real estate solutions. So I think this last week I was on vacation and I called in from Destin to the show and to give my weekly tip. And we had people asking questions like, hey, is now the right time to buy? Hey, what do you do about landlocked land? The other one said, hey, what do I do about something with Zillow? I mean, there's questions all over the place. And so I do my best to give you guys the best advice that I can. So tune in Saturdays from 11 to 1. Here's the one thing I want you to take away is this Saturday, because of July 4th, we don't have a show this Saturday. So womp womp, tune in next week, okay? And then lastly, guys, I want to encourage you. We've muted everyone except for Ms. Janna and myself. If you want to go ahead and look at the bottom of your screen where it has the chat button. That is where we're going to encourage questions. Ms. Janna, I'm going to introduce her in a second, but we're going to encourage that you, if you've got a question, put it in the chat section. But ultimately, we're going to ask that you hold it, because she's got a presentation. She's going to be sharing her screen, and she is going to be giving us an overview look at 1031 exchanges, which in my personal opinion, I think this is something that whether you're a realtor, a real estate professional of some sort, or if you're an investor, you need to know about this strategy and this tool in your tool belt. And so if you've got a question, put it down there so you don't forget it. And if it doesn't get covered through the presentation, we will address it on the back end. So there's that, you guys. Let me go ahead and share just a little bit of information. So we have got First American Exchange. That is the company that Ms. Janna represents. They facilitate all types of 1031 tax-deferred exchanges, including simultaneous, delayed, reverse, and improvement exchanges. Ms. Janna Perret is the Central Region Manager, and their office is located in Mandover. So a lot of you guys are based out of the North Shore or in the South Louisiana part, but I'll have her start off with sharing a little bit of what that region covers. And I'll put in there a place where if you guys have some questions, you can reach out via phone. But ultimately, guys, here's one of the things. We're bringing in someone who this is what they do for a living, and you can have an opportunity here to learn about something that anytime you buy or sell it, I always have learned, as someone who solves real estate problems pretty frequently, the number one red flag that goes off in my mind is, hey, what type of tax event is this going to cause when I buy and when I sell? And so that's huge. I can't tell you how many times it has made or break a deal for sellers and buyers. So this is important here, guys. Take some notes, ask some good questions, engage, and we look forward to having this time be a good time for us as a community. My goal with the REIA is to raise the tide so all boats can be raised as far as education level goes, so that, hey, real estate can change your life. And so this is just one tool in your toolbox to know about. Sharon, without further ado, if you'd like to go ahead, if you don't mind sharing, you said you're the Central Region Manager. So what states do you cover? Is this stuff just pertinent to Louisiana? What if someone lives in Mississippi?
Right. Well, it's a federal law. You're trying to avoid federal capital gain taxes. So we, from our office here in Louisiana, although our office in Louisiana does cover Louisiana, Mississippi, Texas, Arkansas, and Tennessee, I also supervise offices that go all the way up from Chicago, Illinois to Minneapolis, Minnesota. So, and we're right here in Mandeville. So I've been doing 1031 exchanges now for 16 years with First American Exchange Company, and that is exclusively what I do. So seeing just about everything that can happen with the 1031 exchange transaction, and glad to share it with you all. I think it's a wonderful tool for investors and realtors to be aware of. It's if you're into real estate, it's just a no-brainer. If you're selling investment property and buying other investment property, you need to know about 1031 exchanges, because it will help you build wealth and keep all of your money invested in the next property without having to stop and pay capital gain taxes. And so I'm going to go over that with you all. And shall I just jump in, Courtney?
Yes, ma'am. And again, everyone, we're going to make sure we keep everyone muted. But if you want to go ahead and if you have questions, put it in the chat box. We will, if they're not addressed with the presentation, we will address them at the end with Q&A. So,
all righty. So let's see how I flip to my next screen here. Bear with me. A little bit, let's see. A little bit technically challenged on this. Had to, Zoom is not a platform I use all the time. Okay, great, that worked. So what I'm going to discuss today are the mechanics of what you need to know to complete a successful 1031 exchange. We're going to go through some actual math examples to show you how it benefits you for doing this and why you want to do it in the first place. And we'll also discuss a couple of, not only, so 1031 exchanges defers the payment of capital gain taxes when you sell one property and you buy another, but if you later sell that next property for cash, then the taxes catch up to you at this point. We'll also discuss some strategies for avoiding the tax indefinitely altogether, and what your role as a realtor is in the transaction with respect to a 1031 exchange. And I'd also like to introduce you to our new platform that we've developed called Invest Eagle, which I'll tell you more about later on. So here, what is the client trying to accomplish by doing a 1031 exchange? And this is right out of the regulations. So taxpayers defer paying capital gain taxes when they exchange like-kind real property that's held for investment use or used in connection with their trade or business for other real property.
Ms. Janna, are you, right now, we're only seeing you. Do you?
Oh, you're not seeing my screen?
Yeah, no, that's okay.
Okay, let's see. It says I'm screen sharing.
Let's see. Okay, other people can see the screen. Okay, can put in the, yep, okay, other people can see it. It might just be me.
Nod your head if you can see the PowerPoint slides there, please.
Oh, okay, thank you guys. Everyone was giving me, I'm the one who's technically challenged here. Okay, we're getting great feedback that others can see it. Thank you.
Okay, great, great. Okay, so some of the vocabulary words that we use in the industry. The relinquished property is the property that's being sold in the transaction, and the replacement property would be the property that is being exchanged into or acquired through the exchange. The qualified intermediary is a necessary part of the exchange. That's what our company does. We facilitate the exchange. We act as a qualified intermediary, also known as an accommodator, or 1031 exchange agent. We prepare the necessary exchange documents that need to be signed in connection with the closings, and we hold the money in between the sale and the purchase transactions. The exchanger is the taxpayer that is looking to avoid having to pay the capital gain taxes through this process. And the hope with most exchanges is that you have a fully tax-deferred exchange so that you don't have to pay any taxes as a result of the sale of one property and acquisition of another. But sometimes it is still possible to have a partially tax-deferred exchange and maybe have some portion of the gain that is taxable. That is referred to as boot. It's any gain that is taxable. It's called boot. And boot, it would be any cash that you receive as a result of the combined transactions, or any non-like-kind property that is received, such as if you provide a seller carryback financing and you get a note back instead of exchanging all of the cash proceeds into replacement property. So some of the reasons people like to do exchanges in the first place, maybe they're moving from one area to another and they want to take their investment properties with them. You can also use it to increase cash flow from either a low producing property or raw land and exchange it for income producing property. It's another way to diversify or consolidate your holdings and leverage built up equity. And you can also trade out of fully depreciated property and maybe buy something that's more valuable than what you're selling and continue the depreciation schedule. Can also be used to eliminate property management headaches. Maybe you don't want to have to get those phone calls to come fix the rental property, or alleviate a co-ownership property. We have a lot of clients that might own property that they acquired with a sibling, and they no longer want to stay in the business venture together. So it's a good way you could sell that property. The two siblings could sell, and they could each decide to go their separate ways, each do their own exchange. One could take cash, one can do an exchange, for example. And so let's go through the mechanics of what's necessary to complete a valid exchange. It has to be set up as an exchange versus a sale and a subsequent purchase. So there are exchange documents that have to be prepared and signed prior to the sale closing. If the client goes to closing, sells the property, and leaves that closing with a check, and then calls the qualified intermediary, such as our office, and we hate to get these phone calls because the client will call us and say, I just sold a property last week, but I haven't cashed the check yet. And is it too late? And unfortunately, it is. So it has to be set up prior to the sale closing. And the client cannot be in receipt of the property or even in constructive receipt of the property. So they can't go to closing and tell the settlement agent, just hold on to my proceeds, don't disperse them yet. I'm going to decide if I want to do an exchange or not, and I'll let you know. So that is really considered constructive receipt, because even though they haven't physically left with a check or gotten a wire for the proceeds, they're still able to call that settlement agent and say, just send me the money. So that doesn't work either. It has to be set up. You have to contact the qualified intermediary prior to the sale closing and get this set up. The settlement agent has to wire the funds directly from their account to our account. And I think we might have lost Courtney. I don't see her picture. Let's see.
I'm still here. I just took off.
Still there? Okay, you're just not sharing your photo. Okay, good deal. There are two time frames that you need to know in a 1031 exchange. And they both run from the date of the relinquished property closing. So the closing date is day 0. Day 1 is the first day after the closing. So 45 days after the closing date, the client or taxpayer needs to identify a list of possible properties that they're going to consider acquiring through the exchange. They don't have to have it under contract within that period, but it has to be in writing, signed by them and sent to the qualified intermediary, such as your First American Exchange office, by day 45. And then they have to close on one of those identified properties or more. They can purchase more than one property through the exchange by day 180 in the exchange, so roughly 6 months. And if they close on their relinquished property late in the year, it's like after mid-October, does this phrase that's in red here on my screen apply, and they actually have to close on their replacement property by whichever is earliest, 180 days from their relinquished property closing or the due date for filing their federal income tax return for the year that they sold the property. So if they close, say, very late in the year 2020, maybe December 1st, April 15th, their tax filing deadline is going to roll around before 180 days. So all you have to do is file an extension for an automatic extension for filing your tax return, and then you can take advantage of the full 180-day period to purchase. And I'm sure you all have heard the term like-kind exchange, and that carries with it kind of a misnomer, because a lot of people think whatever kind of property you sell, that's the kind of property you need to purchase through the exchange. But that is not true. The good news is all real property in the U.S. is considered like-kind to any other property in the U.S. So you can exchange commercial property for residential, vice versa, raw land. You can even sell a fractional interest for a 100% interest in property, as I mentioned in the sibling example. If you own a 50% interest in property, you can exchange that for a 100% interest in the next property. Even leasehold interest, as long as there's a term of more than 30 years remaining on the lease term, you can exchange that for a fee simple interest in real estate. Maybe you have a camp out in Little Woods and you have a 99-year lease from the railroad. You could exchange that for a commercial office building. Even certain oil and gas rights, so mineral interests, are like-kind to other kinds of real estate. And so we sometimes have clients when oil and gas is usually doing better. I haven't done any of those lately, I can tell you. But they might exchange their rental home and purchase a royalty interest in some type of mineral lease. That works. And this last thing on the list, I wanted to tell you about Delaware statutory trusts, or another attractive option for purchasing as replacement property. And excuse me, I'm a little hoarse. What that is, it's kind of like a REIT, a real estate investment trust. What it is, it allows you to buy an interest in a trust that owns one or more properties, and they're usually investment grade properties, such as maybe like a medical building or something like that. And you buy an interest equal to whatever amount you need in your exchange. Excuse me.
No, you're fine. One of the things is, and hey, for you guys on the right side, for you guys who are going into the group chat, I see your questions. Keep typing in your questions. We're going to tackle those on the back end if they're not addressed fully. Ms. Janna, what is one that you see the most common?
Excuse me, didn't want to cough in your ears. What do I see as like a Delaware statutory trust?
Well, as far as in general, do you mostly just see it as landlords who are taking one property and trading up, or like what's the largest amount of your clientele? Are they?
Yeah, that's a good question. Most of them, I would say probably more than half, are just simple residential rental homes, single family homes. We do a lot of that. There's a lot of people who make a living off of that, and they just continually exchange. We have a lot of repeat clients who do that. But we see a lot of hotels, we see raw land, office buildings, industrial property. So there's the whole gamut. You know, any types of those properties can be exchanged, but the majority is simply residential single-family homes.
So this is really important for you guys. I want to give you a second to drink some water and whatnot, but this is really important because as someone so I'm an investor and I buy. So this is important to me as an investor, but this is also important for me as someone who buys from sellers. So for example, there's times that I've bought from landlords and they didn't know that this was an option and they're stressed about paying the taxes they're going to have to pay during the sale. So not only is this a good tip for you to have in your tool belt for you as an investor who will eventually maybe sell some properties, or I know there's multiple people. I know for a fact that there's multiple people watching this who are gearing up to sell something right now that this applies to you. For those of you who are like, oh, you know, I'm not selling anything right now. Also keep this in mind though, just everyone keep this in mind for when you are buying, you're also dealing with the seller. And this can also maybe help you win over a deal because you're solving a problem that seller has, which is their concerns with the taxes.
Good point. Good point. So just let me finish my point on the Delaware Statutory Trust. What those are, and they're attractive. They're considered a security interest. So you have to be an accredited investor in order to qualify to purchase that. So you have to have a minimum net worth or income for the past 2 years. But it's an attractive option that we're seeing some of our clients gravitate to, so particularly like maybe older folks who have been landlords all their lives and they no longer want those management headaches. They can do an exchange on maybe, you know, however many rental properties they have, and then even diversify and buy several different Delaware Statutory Trust interests. Some of them, you know, there's one in particular that puts together a pool of maybe 20 triple net lease properties, and when you buy into it, you then own 20 different shares of 20 different properties all over the country and that are diversified. So, and it eliminates management headaches, and it's an attractive option. So if any of you are interested in following up with me on that, feel free to do so. I have a great article on this, and I have some people who market these that I can put you in touch with if that is right for you or your clients. All right. Now, why this works sometimes and not others? Let's see. Sorry about that, guys. Bear with me a second while I'm trying to figure out why I've got my camera on my laptop and I have my monitor on. That's not working. Let's see. Shoot. Oh, there we go. Okay. So in order to be able to exchange property, it has to be a property that's held for investment purposes. And that held for requirement is something that you need to consider. So it's not for property that is just held for sale, for example. So flipping properties, if you're in that business, it doesn't qualify for 1031 exchange. It has to be property that's held for investment. It can't be something you use for personal use. So your personal residence cannot be exchanged. You cannot sell an investment property and purchase something to live in. Not even a second home would qualify. Okay. And the same taxpayer who sells the relinquished property has to acquire the replacement property. And there are some favorable exceptions that do allow for some liability limitation. And so if you have a single member or an individual who sells property, that individual can form a single member LLC to purchase a replacement property and still get that liability protection. And in Louisiana, since we're in a community property state, you can have a husband and wife who sell relinquished property, and they can form an LLC in which they are the sole members to purchase a replacement property. So kind of good things to keep in mind. You can also use your revocable trust. You can sell in your individual name and purchase through your revocable trust, or vice versa. All right, let's see. Whoops. Okay, I was trying to, I see my video has stopped working, so sorry about that. I'll just hide that lovely picture of myself there. And let's see. Okay, so because the intermediary is holding the funds in the transaction, of course you want to make sure that you're trusting a qualified intermediary that you know is going to safekeep the funds. So at First American Exchange, we open individual FDIC-insured bank deposit accounts where we hold every client's funds. So we hold those segregated. We never commingle them. They're in separate accounts. Our company is publicly traded. We're under the First American Financial Corporation is how we're traded. $6.2 billion in revenue last year. We operate as a direct subsidiary of First American Title Insurance Company. Because we're publicly traded, we're governed under the Sarbanes-Oxley Act, which means we have to be audited by an outside auditor at least annually. And we do cover multi-million-dollar fidelity bond and professional liability insurance. All right, so now I want to go through understanding the math in an exchange. So as Courtney mentioned, when you sell property, and the first thing comes to mind is how much taxes am I going to owe on the sale? And in order to calculate that, you first need to know how much gain you're going to make on the sale. And in order to calculate gain, you first need to know what is my adjusted basis in the property. So what do you have in it? What's your tax basis is also what it's called. And so you start with what you originally paid, the original purchase price. You add any capital improvements made to the property and subtract any depreciation deductions. And that's the adjusted basis in the property. And then once you have that adjusted basis, then you, let's see, that didn't switch. Sorry about that. I think I was on an earlier slide. My apologies. So this is how you calculate the adjusted basis. So then once you have that adjusted basis, you calculate the gain. To calculate the gain, you start with what you're selling the property for nowadays, subtract that adjusted basis, and subtract costs of sale, such as commission and closing costs. And that's the gain that you would be taxed on. And there's different tax rates for different categories of gain. And the IRS is, of course, going to assess the highest applicable tax rate first. So any additional depreciation that was taken that is in excess of what straight line depreciation would be, such as maybe if you bought a property in the go zone and you took accelerated depreciation, the amount of any additional depreciation taken over straight line depreciation is taxed at the ordinary income rate, which is a maximum of 37% for individuals. Any straight line depreciation is taxed at a flat rate of 25%, regardless of what tax bracket you're in. So depreciation is a great tool for owning, for people who own investment property. And just a little word about depreciation. Commercial property is depreciated over a term of 39 years, and residential property over a term of 27.5 years. So, for example, if you buy an investment property and the building itself, it's the building, not the land. Land is not depreciable. It's only the value of the improvements to the land. So say you buy a property and the building on it is, it's a residential property, and the house is worth $275,000 to make the math easy. you get to write off from your income, your adjusted gross income, $10,000 every year for 27 and a half years. So, for example, if your income for that year is $70,000, you get to reduce that income by $10,000 depreciation deduction. So only $60,000 of income would be taxable. So a great benefit for owning investment property. However, when you go to sell that property, all of those depreciation deductions that you've been taking over the life of ownership, you have to recapture and pay it back at 25%. So if you have a client, or if you've owned property for a very long time and you've depreciated it down to very little value, that could be a huge tax hit. So something to look for people who've owned property for a long time. Then the federal capital gain tax rate is assessed on the appreciation in value, the amount that the property goes up from what you paid for it when you bought it and what you're selling it for nowadays. And so the maximum rate for the federal capital gain tax, if you've owned it over a year, it's called long-term capital gain, is 20%. It's either 15% or 20%. And the threshold is around $450,000 for a single person, it's close to $495,000 for a married couple. So you'd have to have income, including gain from the sale of your investment property, of over that before the 20% would kick in. Otherwise, it's 15%. And if you own the property for less than 1 year, you're going to pay short-term capital gains, which is taxed at your ordinary income rates. So here's another big key takeaway. If you're going to buy investment property, hold it at least a year. Otherwise, you're going to pay a lot more in capital gain taxes if you own it for less than a year. And I don't know if you all are aware, but in 2013, President Obama passed the Medicare Act, which enacted a 3.8% tax on unearned income. And that includes the sale of real estate. So, and it only affects high income earners, but the threshold is lower than the capital gains rate. So it's $200,000 for if you're single, $250,000 if you're married. So if your income, including gain from the sale of your investment, is more than that, this 3.8% tax is also going to apply, plus any state tax. And in Louisiana, we have a 6% income tax. So all of these are taxes that you would be looking to avoid or defer by doing a 1031 exchange. Okay, so let's look at an example of how this applies. Let's say you have a property that you're selling for $400,000, and you bought it a while back for $200,000. You didn't make any major capital improvements to the property that would increase your basis, and you've owned it a long time, so you've been taking straight line depreciation in the amount of $150,000. You have a mortgage balance on the property of $200,000. Maybe you refinanced it recently to do something with those funds. So in this case, your adjusted basis in the property would be only $50,000. So that's what you originally paid minus the depreciation taken, and you add any capital improvements. None in this example. So $50,000 adjusted basis. And when you sell it, the capital gain is going to be the sale price minus the adjusted basis, or $350,000 of gain. Taking that one step further, that $150,000 of depreciation taken is taxed at 25% for $37,500. The appreciation in value, $200,000 that went up in value, is taxed at 20% if you're a high income earner for $40,000. And if the Medicare tax applies, the total gain times 3.8% is another $13,300 for a total of taxes of $90,800. Now, if you went to closing after paying off your mortgage, and note, by the way, your mortgage has nothing to do with calculating your basis or your gain. That doesn't apply, it doesn't fit into the equation for that. But let's say you go to closing, sell the property. After paying off the mortgage, you leave the closing with a check for $200,000. Come April 15th, you have to pay $90,800 in taxes, and so that you're left with $109,200 in your pocket to reinvest. If you do a 1031 exchange, however, those taxes are simply deferred. You don't have to pay them. So one step further, if you were to leverage in either scenario the amount of cash that you had left into a 75% loan-to-value purchase, so you put 25% down, if you do a sale and subsequent purchase, you have buying power of $436,800, whereas if you do an exchange, you have $800,000 worth of buying power. So that's huge. That's the big picture. So that's why you do a 1031 exchange. Defer the payment of those capital gain taxes and use those tax savings to acquire more property, build wealth. And in order to have a 100% fully tax-deferred exchange and not have to pay any capital gain taxes, it's called the Napkin Test because supposedly it's so easy you could figure it out on a napkin. But it's the first line. If you can remember this first line, this is what you need to do. You need to trade equal or up in value and equity. So trade equal or up in the sale price. If you sold in that example for $400,000, you have to buy at least $400,000 of replacement property. And whatever cash you had left, so that $200,000 of cash you had, you need to reinvest in replacement property. You can't pull cash out and borrow more money to make up the difference. You have to keep all the cash invested. So that's the simple rule, the Napkin Test for a fully tax-deferred exchange. So what that means is any debt that you pay off, you need to replace that debt with new debt on the replacement property or add cash out of your pocket to make up the difference. And as I mentioned, it is possible to achieve a partially tax-deferred exchange. You don't have to always have a fully tax-deferred exchange, but you would be taxed on whichever is greater, the amount that you trade down in value between the properties or any cash that you pull out. All right, so that's the basic rules. A couple of tax avoidance strategies that I have for you. So one is what we call swap until you drop. And basically that just means stay invested in real estate all your life. The result of an exchange is that the amount of gain that you defer by completing an exchange reduces the basis in the replacement property. So when you later go to sell that replacement property, if you don't do another exchange, that's when it's taxable to you. That's when the taxes catch up to you. But you can continually exchange one property for others all your life and defer taxes indefinitely and never have those taxes catch up to you. And your heirs inherit any property that you leave them at the fair market value. So if mom and dad pass away and they leave their children $1 million worth of real property, when the kids get it and they decide they don't want to be in real estate, they just want to sell it, they sell it soon after for $1 million, there's no gain that the heirs are taxed on. So definitely a good tax investment strategy. Y'all still there? I think I lost my clips. Everybody still there? Okay.
Yes, you're doing great. I think
Okay.
that is valuable info. Hey, if you guys are getting some good stuff out of it, put it in the comments section.
All right. So that's the swap until you drop strategy. Next is if you convert personal residence to rental property. And this is useful if your gain is over the Section 121 limits. So maybe all of you on the call are aware that when you sell your primary residence, as long as you've lived there an aggregate of 2 out of the 5 years before the sale, you get to take up to $250,000 of gain tax-free if you're single, and $500,000 of gain if you're married. So that's gain, not sales price, but gain. So if your gain is over these limits, which maybe if you owned a property for a very long time, it might be, or if you live in California or something like that. But I don't know. I think we'd be a little hard-pressed to see some of those gains here locally. But if that were the case, you can combine Section 121 to exclude the gains that you're entitled to and Section 1031 to defer the rest. But what you first have to do is you have to convert the home to a rental property, and 2 years use as a rental is recommended. And then you can sell the property and both exclude gain under Section 121 and defer the gain on the balance. And the amount of the replacement property that you need to fully defer the rest of the gain is reduced by whatever gain you exclude under 121. And let me show you some examples or an example rather, of what this looks like. So let's say you have a married couple that lived in their home for 20 years. They bought it for $100,000 and it's now worth $1 million. So if they sold it, they would have $900,000 of gain. If they sell it without converting it to a rental, they just sell it, they could take $500,000 of gain under Section 121 tax-free, but they would still have to pay capital gain taxes on the remaining $400,000 of gain. However, if they decide to convert the property to a rental, rent it for 2 years, and then sell it for $1 million, they can take still their $500,000 of gain under Section 121 because they lived there at least 2 out of the 5 years before the sale, and they can set up a 1031 exchange to defer paying tax on the balance of the gain. So, and then in order for them to have 100% deferral of the balance of the gain, then they only need to buy $500,000 of replacement property. Again, because the $500,000 that they got to take under Section 121 reduces the amount of property that they need to purchase through the exchange. So, and if they're selling for $1 million, that means they only need to buy $500,000 more. So it's a good tax avoidance strategy. And the last strategy that I have for you is converting investment property to a primary residence. And I see this a pretty good bit. It's a really good strategy to work out and to kind of work towards. So it allows you to exchange your investment property into your target residence. So what you do a 1031 exchange. Maybe you have somebody who's had a business property for years and they're retiring. So they're going to sell their business property. They've got a huge gain. So they purchase something that they're going to ultimately want to live in. They have to rent it for a while, again, because in order to qualify, it has to be used for investment purposes, the property that you purchase, and not for personal use. So 2 years is a good rule of thumb. They buy something, rent it out for 2 years, and then they can move into it, and they have avoided and never have to be taxed on their capital gain that they deferred through the 1031 exchange. So it's a great investment strategy. But let's say maybe they decide that after they've moved into it and lived there for a while, maybe they want to move someplace else. Then they want to sell the property. Then in that case, in any gain the gain that is excludable under Section 121 is reduced pro rata by the number of years that they used the property for non-primary residence purposes over the total years that they owned it. And I'll show you what this math looks like. And there was a change that came out in 2009 that says if you buy property through a 1031 exchange, you have to own it at least 5 years before you can sell it and take some of the gain tax-free under Section 121. So there's a 5-year wait before you can, sell the property and still take some of that gain tax-free. Again, though, if you just use it to sell your investment property, exchange it for something you're going to move in and live in it for the rest of your life, you never have to worry about the last 2 bullet points. You've successfully achieved deferring all of your capital gain taxes and used it to buy the big, your residence of your dreams. But let's see what this looks like if you were to sell it. So let's say we have a married couple who exchanged into an investment house. They rent the house for 3 years first so that they qualify as investment property, and then they later move in and live there for 3 years. They sell the property after 6 years for a total gain of $800,000. Then instead of being able to exclude $500,000 of gain under Section 121, they cannot exclude gain for the period that it was rented. And so since they rented it for 3 out of 6 years, 50% of the gain, or $400,000 of their gain, is not eligible for exclusion. Therefore, the couple can exclude $400,000 of gain rather than their $500,000 when they sell their primary residence. So it does reduce the amount of gain that you can exclude for the period you did use it as a rental, but it's a great way to convert investment property to not only defer the payment of capital gain taxes, but exclude all or some of it. All right, and I wanted to tell you a little bit about, I mentioned this Invest Eagle platform that our company was very excited to roll out last year. It allows brokers to upload commercial properties. It is just for commercial, it's not for residential property, it's not the MLS, but it allows brokers to upload commercial properties that they have for sale on the website. And our exchange clients are encouraged to visit the site and enter their search parameters. They can they can search by city, state, and or zip code, and what type of property they're interested in, such as office or single family or triple net lease or hotel, whatever they're interested in. And the site will automatically match them to all the properties and listings that fit their criteria. And then their anonymity is protected in the meantime, and only when they indicate an interest in any property that was matched to their criteria does it send a notice to the broker and connect the two so that the two can make a connection. But it's complimentary, free to use, so please check it out. You can use it to search for your ideal property. And if you're a realtor, you can upload your commercial properties there and get them in front of our 1031 investors at no charge.
One quick question on that is 2 questions on it. One, are y'all planning to involve residential in that? Or is that just for commercial, or is there no goal for that?
It's, right now it's just for commercial. I think that there are some, maybe some compliance issues with doing residential for now, Courtney. So for now it is strictly for commercial. And
then secondly, you've got to be licensed. It can't be like, say, for example, if I owned an apartment complex as an owner, I couldn't list it on there?
No, we wanted to protect the brokers, and so it's not just for owners to use. It's kind of broker driven, so you do have to be a licensed realtor to be able to upload properties to the site.
Okay, but it's good to know if you've got a property that is commercial or maybe even potentially industrial, I don't know, that can get put on there. Like, for example, I know I have family property that is commercial, that it is desirable for investors in the sense that's in an opportunity zone and all these other things. But hey, it's listed. I have a family member who's an agent. It's listed with them. I know I'm going to have them look at this.
Great. There's all sorts of wonderful videos that kind of walk you through using it, and it's very user friendly, and it's still a work in progress. So we love any comments and feedback when you go to the site. It's also supported by a help desk, so it's that First American runs. So I invite you to check it out. All right, and let's see. So what's in all of this for you if you are a realtor? So, knowledge is power. This is definitely a tool that you can use to educate your clients about the benefits of 1031 exchanges. Any client that you're going to save money is going to be a client for life, and they're going to tell all their friends and colleagues about their great realtor who pointed them in the right direction and saved them a lot of money. So it's definitely a tool that you should know as a realtor, and certainly if you're an investor as well. For realtors, it's a way to increase your real estate commission by also, when you get a commission when you sell the relinquished property, but also when you help that client find their replacement property, there's a commission on that part of the transaction as well. And I think, as Courtney mentioned in the beginning, it's a great motivating tool for people who are worried about a big built-up gain and a big tax hit to sell their property. Sell their property, buy something that's that's more suited to their liking, maybe more income, less management headaches, and so it's a great thing to mention to get them to exchange out of their current investment into something more suitable. And so your role as the realtor, I say raise the issue. That's the biggest thing. If you're representing somebody that's selling anything other than their primary residence, raise the issue. It has to be set up prior to the sale closing, and you're in the perfect position to raise that issue with your clients and help them to benefit from this tool. It certainly helps clients build wealth and accumulate more assets by deferring the taxes. And keep in mind, you don't need to know all of these minutiae and all of these rules. You just need to recognize the need and then contact First American Exchange, who can help your client facilitate the exchange. And remember to contact us before the closing. We are glad to be a resource for you and your clients. We're happy for you to pass out our name and number. And really, we basically offer free consulting services. We consult with the client and talk about whether this exchange might work for them and how it works, and go over all the rules and requirements with them. And then they can decide on their own whether they want to do an exchange or not. But we don't get paid until they sell and close their relinquished property through a 1031 exchange. So always happy to go over the rules and requirements with your clients, so feel free to have them contact us directly. Here's my contact information. This is our office number. We have a number of exchange officers on hand and exchange assistants that can help as well. So if I'm not available, you can ask for an exchange officer. That's my email address too, and our website, which I invite you to check out as well. And that is all I have.
Excellent, Ms. Janna. Look, there is a level that you guys, so I know in here there is maybe one or two realtors, there's a good bit of investors, and from the people that I know on here, you guys range in a lot of different things that you do. So here's what we're gonna do. I wanna go ahead, I wanna start addressing these questions that we have. This is your time. If you've got questions, you haven't put it already, go down the bottom of your screen where it says chat. We're going ahead and put it there. And let's start here. Kate asks, she says, how long does it take to set up a 1031 exchange? Jen, I know you talked that the importance is doing it. You've got some stuff you need to do and set in motion before the closing, but how long does it take to set it up?
That's a good question. And comfortably 3 days notice, 3 business days notice prior to closing is really all we need. We're very automated and we can get documents done sooner than that. I always tell people if they haven't sold yet, it's not too late to contact us. So we even sometimes get called from the closing table. You know, hopefully the title company knows to recognize when somebody shows up and says, you know, I'm doing a 1031 exchange and they haven't set up any exchange documents. They can call us and we can get documents done pretty quickly, usually in about a half an hour. So.
And that's important. Investing is a team sport, you guys. So if you're not working with a title company who's hey, giving you some tips and tricks, that's huge. I've sat at plenty of closing tables. Now my role is I haven't been in the stage of life where I'm selling a whole lot of the long-term holds and stuff. I'm starting to do more of that. But what I do is I'm buying from a lot of investors. I'm buying, you know, people who are retiring and wanting to get rid of their rentals, or people who inherited a property, turned it into a rental, or people who are moving out of their primary residence, turned into a rental, and they're just not fit to be a landlord. There's so many scenarios like that. And if you're not sitting across, you know, with title attorneys who helping, you know, make it a win-win-win across the board, that's huge. And so, let's see, Vince, look, that's huge as far as you guys bringing value into the marketplace for people you're buying from, whether that's a FSBO or if you're a realtor dealing with sellers, or even for friends and family. Vince says, does the straight line depreciation clock start over, or does it append value-wise? I believe you addressed this a little bit.
Right, that is a great question. So what happens is if you, the property you purchase through the exchange, you carry over the basis from the one you sold, and you continue to depreciate that property on, or that portion of the basis on its original schedule, and then you get a fresh depreciation schedule on any excess basis that you acquire. So you do have to trade up in value if you want additional depreciation deductions to be able to take that. But great question.
So Chris, thank you guys for these questions. I always enjoy, and I'm proud of you guys when you guys engage. So Chris, she said, what happens if you pick a property within the required time frame, but the deal falls through after that point?
Yeah, that's tough. And you only have 45 days to name a list of properties. And what I didn't go over is the rules in which you can identify. So you can identify under either the 3-property rule or the 200% rule. 3-property rule, of course, lets you identify up to 3 properties at any value. That's what most people use. But if you were selling maybe a very valuable property and you wanted to diversify, you could identify more than 3 properties, any number in fact, as long as the value of all the property you identify isn't more than twice the value. It doesn't add up to more than twice the value of what you sold. And so it's good to identify some alternates. If you have your eyes on one target replacement property, name those 2 other backups under the 3-property rule so you have some other options. And I have even seen some clients go on and sign contracts on as many properties as they can within the 45-day period, maybe all 3, and then have some kind of a back out in the contract so that they can back out of the ones they don't want and keep the one they do. Trying to get them under contract within the 45-day period is a good strategy.
So what if in this hot market you name 3, but by the time that you make offers on them, let's just say you're at this table and the title attorney says, you know what, let's call them, let's give, within 30 minutes you guys filled the paperwork and you just started a 1031. Now you're in the 45-day period. So today you go and look on and you identify a few properties. So you send those, and I may be naive here saying this example, but let's say they send these 3 properties to you that you just found on Zillow or something that fit your criteria of something that you like. And then let's say the next day you start making offers, but you get outbid on all of them, or you get outbid on 2 of them, and then one of them falls through because inspections were so bad.
Right.
Is there a penalty there, or can you try again with more properties, or do they applaud the effort? I mean, like,
This is the IRS. So you can amend your identification within the 45-day period, but not after it. So it's really important to, I guess, try to tie up and get properties under contract within that 45-day period, if possible. Otherwise, if the 45-day period passes, you had identified 3 properties and you're not able to complete a purchase of any of those identified properties, then unfortunately you're not going to be able to complete a 1031 exchange, because you have to buy from the list that you identify within the 45-day period.
Okay, that's good to know.
Some clients do come to us with their replacement property already under contract. They say, okay, I've got both of them lined up, and they, so some people are, it just kind of depends. Maybe you can, if you have the luxury of telling your buyer you want to sell them this property, but you need to have the option to extend the closing date, for certain periods until you're able to identify and lock up your replacement property. Some do that as well.
Sure. I definitely have seen that happen. So while it's fresh on my mind and we're talking about closings, that 1031 exchange, let's say I'm selling my property and someone who's a 1031 exchange person is buying it. Is that seen as cash? Or like, how is that buyer, like, what is their position? Is it a cash position? Is it a financed position? Because, like, for example, cash is king. If you've got a cash offer, I mean, you're going to win a lot of times out against a finance offer. So how is that seen in a transaction? If that question makes sense.
I think I understand what you're asking. I guess it really just depends on what the client's position was when they sold the relinquished property. So how, if they sold for $400,000, they had a $200,000 mortgage that was paid off, and $200,000 of cash was sent to us to hold in their exchange, but they need to buy $400,000 worth of replacement property, then they're probably going to need another $200,000 mortgage.
Okay, so it could be, so it depends on the property you sold, whether it was owned outright or it was financed, how it's going to be viewed whenever you're making offers.
Exactly.
Okay. So for you guys, the reason why I asked that question is it's important because, hey, if you own a property outright, although you're doing this situation, it doesn't change your cash position as far as being a cash buyer. From what I'm understanding, it doesn't change that position. So if you own this property outright, because I know a lot of times cash can help you, but also keep that in mind. Hey, if you've got a leverage, if you're required to leverage, then you're going to be having to buy properties with that leveraged financing, those terms on your offers. Let's see, Bob Norton, who's our real estate specific CPA, who's always joining in. He's one of our sponsors. He said you have to live in it for 5 years before selling it and qualifying for Section 121. When talking about your primary, the one where the primary resident was like, you're trying to get your perfect house.
Or sell something that you have purchased through a 1031 exchange. So you buy a property, you do a 1031 exchange, buy a property that's what you want to ultimately move into. You have to use it first as a rental, then you move into it. You have to hold it at least 5 years before you can sell it and take some of the gain under Section 121.
If you're like, hey, what is this Section 121? on July 2nd, Bob and I, the same Bob and I, are going to go over ways that you can give, you can take the house that you live in and some creative ways as an investor, some things you can do. So we can dive, we're going to definitely be diving and tearing apart Section 121. Because I don't know about you guys, but my primary residence is currently being used in a strategic manner. And it's, look, if you're not, I'm not going to say this, but if you're not crying during tax time, there's a level that I'm not going to say you're not crying, but there's some of my mentors who own a lot of assets or own a lot of businesses. They kind of get grumpy around tax season. And it's one of those things because as you build wealth, it is something, it's a huge factor. And so I don't know any other way to say it as that, but it becomes a huge factor. So learning these different ways can help you as far as building that wealth and the strategies. So let's see, Brittany asked if you can email the slides. Ms. Jan, I don't know if that's something that you're open to, but I do have a way where instead of emailing it, I can upload it on the site and people can go and, get it from there. Or we can look at emailing it.
I'm glad to email it, Courtney, and I can just change it to a PDF and send them that way. I'd be glad to. If you wouldn't mind maybe sharing the email addresses with me. Yeah, I can help you facilitate that. I know it's a lot of this is meaty. So one thing I want to recommend, guys, is back in February, we had Quest Trust come and talk about self-directed IRAs and other. That was really meaty. That's one of those things is understanding, like Ms. Anna said, is understand when you need to recognize the need and then have someone, again, investing is a team sport, understand, build your team, find out if First Exchange is the one who, you'd want to have on your team for something like this, a First American. And so, because they can then become that consultant that can help. You don't have to know it all, because I know a lot of it is, hey, I want to know the nitty gritty. You just need to have, hey, this is a relationship that I leverage to understand when I come across these situations. So, Ms. Jan, I'll definitely help you facilitate that. Justin, when he was asking about Invest Eagle, he said, can an agent list it on the site without it being listed on the MLS? If it's a commercial property, then yes, or raw land too. I meant to mention that too. That raw land is fine to upload on the site as well. Just not a residential single-family home.
And you said that there's a support, like it's free to use, and that there's a support, like tech support team.
That's right.
Okay, so Justin, I know your situation is land, so that's pretty funny and timely that she asked that she mentioned that. So go and check out the site, and there looks like they'll have some tech support. Paul asked if you don't mind explaining your fee structure, like how you guys are involved. Is that something that how does that look?
Sure. Well, every QI does it differently, but ours, we break our fees down on 3 tiers. It's based on the sale price of the relinquished property, but anything under $1 million is $895 to set up the exchange, and that covers 1 sale and up to 1 purchase and everything in between. Okay. So that's our fee, and we take that out of the proceeds once we receive them.
And so then that is used as a cost of sales. Is that something that is, because when you talked about as far as understanding your gains, is that something that is line item under our cost of a sale?
It is. So it reduces the amount of replacement property you would need to purchase to have a fully tax-deferred exchange.
Okay. All right. Kate asks, can you buy multiple properties from multiple sellers to add up to a larger investment for reinvestment of the funds?
You can. So you can exchange any number of relinquished properties for any number of replacement properties. Sometimes we see investors selling 2 or 3 rental homes and purchasing one large commercial property, for example. Or you can have somebody, we had one exchange where somebody, actually the family members were selling a resort, and it was in the over $100 million, and they exchanged it for about 30 different purchases. So any number of sales can be combined into any number of purchases. Again, the goal in any one exchange, any one 180-day exchange period, is for fully tax deferred to trade equal or up in value and equity.
So this may be a great question there, you guys. Great questions all around. So for example, what about new construction? It takes time. What does that look like? I know there are people in a common trend in the investment world that's coming more and more, is the build to rent. For example, you take one of these larger scale builders and you buy one of their properties that they're building, but sometimes it's available today, sometimes it's available in 3 months. What does that look like here?
So you certainly can buy a new construction through a 1031 exchange. You can sell your relinquished property and purchase the property from the builder. You just have to identify, the rules require that you identify what you're planning to acquire. So if it's under construction, you would identify the land and the improvements that are being made to the land. And as long as it's completed and able to be purchased within the 180-day exchange period, it works. So that's if you're buying it and somebody else is building it, you're buying it from the builder. But it is also possible to do what's known as an improvement exchange or a build-to-suit exchange. And you can use these tax-deferred proceeds to build or improve your target replacement property. And one of the ones I did a few years back that I remember very well, I did actually an improvement exchange for Chef Paul Prudhomme. It was pretty cool. He sold his Magic Seasoning Blends facility off of Jefferson Highway, and he wanted to build a bigger one. So he did an exchange with us, and he purchased the land. And what it requires, though, is that you can't just buy something and then make improvements to it and have the value of the improvements qualify in the exchange. So the workaround is that we actually take title to the land through a new LLC that First American Exchange is the sole member, and we acquire the property that the client wants to improve and sit on title while the improvements are added. And once the improvements are added, or whatever value they're able to get in within the 180 days, they don't have to have it fully completed, but whatever has been constructed and paid for within that period counts in the exchange. And then we transfer title to that improved property over to the client, and they're able to build their target replacement property. However, I can tell you it's not for everybody because the fees are higher for doing something like that. We have a lot more liability, and it's a lot more complex than just selling and buying something already constructed. When we're on title and whatnot, we actually will even sign the note and mortgage through that they arrange their lender to loan us the money for the construction. And we're talking a good bit more to do that. Upwards of $5,000 extra to do that. And we also require a clean phase 1 environmental site assessment if the property is anything other than 1 to 4 family. So it's not for everybody, but it's a nice option if the math works out right.
Sure. Here's one of those things, guys. There's a lot of variables. Your situation may be different. You may be coming across a different situation. I know about 3 people's situation who are in the group alone that could beg the question of, hey, what to do in this situation. Let's see, Chris and Vince both gave a comment and a question. about the trust. Chris said you could essentially name a Delaware statutory trust as a backup if the main opportunities fall out to avoid any issues. And then Vince said the Delaware statutory trust, like a REIT, to exchange the relinquished property for shares, same rules such as that the trust or a REIT pays dividends and must cast off at least 90% of the earnings back to the shareholders as dividends. He asked that as a question. Janna, I don't know, do you want to, is there something to address there? Are they on the
First off, the Delaware Statutory Trust is a good fallback option. If you can't get, because, you know, these sponsors of these types of investments have these properties, you know, kind of ready on the shelf. And so it is a good fallback option. You could name something like that, and then you would be able to achieve, you know, a successful exchange if your maybe other target brick and mortar property doesn't work out. And
Okay.
then the other question about a REIT, it isn't a REIT. The reason a REIT is not considered, a purchase of an interest in a REIT is not considered the purchase of real property, but a Delaware statutory trust is. So there's a revenue procedure or a ruling, I can't remember which now, on that allows you to buy into a Delaware statutory trust through a 1031 exchange, and it's considered like-kind real property. You know, I don't know about if there's any type of required percentages of dividends or whatnot to be paid, but they do pay out monthly income, and then you also have the expectation of appreciation in value. But they are, as I said, a security, and they come with a private placement memorandum that tells you what the anticipated rate of return is on the investment.
Excellent. Like, you guys, that's getting a little bit deep in the weeds. That's not a bad thing. It's just not always something that can be dived really deep into on these webinars. Again, it's understanding when to get an overview and when to say, hey, you set up a phone call, something along those lines, because everyone's situation is different. I know right now I'm in the process of pitting in offers on some multifamily, and literally I'm sitting down with the sellers, and a whole part of our offer is making sure they understand what this situation looks like. Each one of those is, each situation is going to look different for every single person. Well, excellent. Well, Ms. Janna, this has been excellent. You've got a lot of great feedback in the comment section saying that it's been a great time, helpful webinar. And I want to thank you again, Northshore REIA. Look, our goal here is to help raise the tide. Look, even if just little things like this can help some of you guys build some wealth as far as being able to defer some of those taxes so that you can maybe buy another property. I mean, the example you gave, the first example you gave where it was like almost $100,000 that it was $90,000 you would have had to pay in taxes, but you were able to, in that example, if they did a turn 31, they can exchange 90,000. That could easily be another property. So those things are huge. And one of those things is, look, these are good tools to keep in your tool belt. Understanding investing is a team sport. One of the things I want to encourage you guys is Ms. Janna's information is on here. I'm going to help her facilitate sending out this to you guys by email. So keep an eye out on the email that you signed up for the webinar on, and just give us a little time with COVID and other things. It's not going to be coming immediately, but we'll get it to you. Look, stay tuned in, stay connected. This market is crazy. We don't know what's going to happen tomorrow or the next day. So a few other reminders: July 2nd, July 7th, we have 2 more webinars. So however you heard about this, whether it was Facebook, meetup.com, or our website, which is LA-NorthshoreREIA.com, check us out. And then July 14th, we're going to be COVID conscious, but we're getting back into slowly but surely into our in-person meetings. And so if you guys are open to that, you can wear a mask if you'd like. But we're going to be COVID conscious with that and getting back to that networking and meeting in person. That's going to be a good panel there as well. Ms. Janna, thank you so much. It's been great learning from you. And thank you everyone who's taken some time out, Ms. Janna as well, on your Tuesday night. And thank you guys for attending.
Thank you so much, Courtney. Thanks everybody for the great questions.
Excellent. All right, guys. Ms. Jan, if you don't mind doing the end all 4 down at the bottom.
All righty.
Thank you guys. Have a great night.
Good night.